Are you curious about what a recession is, how it happens, and how its effects are on the financial markets? A recession is a period of economic decline, and its causes can vary from tight monetary policy to geopolitical events. However, the impact of a recession can be widespread, including increased poverty rates and reduced access to credits. But there are strategies that investors can adopt to minimize the negative effects of a recession on your portfolio. In this video, I will talk about the early warning signs of a recession and the best asset class to invest in during a recession. If you are interested, you can click on the link below to get this infographic and the full blog post that I've written about this topic. Now, first, what is a recession? A recession is a period of economic decline characterized by falling GDP, rising unemployment rates, and contracting consumer and business spending. It is typically caused by a variety of factors such as a decline in demand, an increase in supply, or a change in consumer behavior. Recessions can be triggered by a variety of events such as an economic shock, a geopolitical event, or a financial crisis. They can also be caused by external factors such as changes in global trade patterns or shifts in commodity prices. To combat a recession, governments and central banks often use a combination of monetary and fiscal policies to stimulate economic growth, such as lowering interest rates, increasing government spending, and providing tax incentives. Recessions can have significant long-term impacts on both the economy and society, such as increased poverty rates, reduced access to credit, and decreased consumer confidence. So, what causes a recession? Number one, tight monetary policy. When the central bank raises interest rates to control inflation, it can cause a recession as it reduces borrowing and spending. Next, bursting of asset bubbles. If there's a speculative bubble in asset prices, such as in real estate or the stock market, a sudden drop can cause a recession. Next, external shocks. Major events such as natural disasters, wars like what we saw in Ukraine recently, or pandemics can disrupt the economy and lead to a recession. Next, fiscal policy. Changes in government spending or taxation can affect the economy and lead to a recession. Next, shock supply. A sudden change in supply, such as a major oil price increase, can lead to a recession as well. Next, we have a banking crisis. A major banking crisis can cause a recession by reducing lending and investment. Lastly, we have trade imbalances. Large trade imbalances or protectionist policies can cause a recession by disrupting international trade. These are just a few of the factors that can contribute to a recession, and often it is a combination of multiple factors that lead to a recession and not just one or two factors. What are some of the early warning signs of a recession? There are many things that you can look out for that may indicate a potential recession. First, we have an inverted yield curve. This occurs when short-term bonds have a higher yield than long-term bonds, which is a sign that investors have lost confidence in the economy's long-term prospects. Now, this is what we are seeing in the yield curve. Next, we have high levels of debt. When individuals, corporations, or governments take on excessive debt, it can create a financial burden that can be difficult to sustain in the long run. Next, we have a slowdown in job growth. If job growth begins to slow down or unemployment begins to rise, it may be an indication that the economy is weakening. Next, we also have a decrease in consumer spending. When consumers start to cut back on spending, it can signal a decrease in consumer confidence and lead to a weakening economy. And lastly, a decline in the stock market. Since the stock market is also a leading indicator, a significant decline in the stock market can indicate that investors are worried about the economy prospects. Once again, it's also important to note that no single indicator is going to predict a recession with certainty, and often it is multiple factors that that combine and contribute to an economic downturn. So when you are trying to figure out, right, or look out for an early recession, it is best to look at all these factors in conjunction and see how they interact with one another. Okay, so for the most important part, how does a recession affect the financial markets, right? And how does it affect your portfolio? Okay, so the first is a stock market decline. During a recession, the stock markets tend to decline as investors become pessimistic about the economy. So for example, during the 2008 recession, right, the global financial crisis, the S&P 500 fell about 56% from its peak in October 2007 to a low in March 2009. So next we have the bond market rally. When stock markets decline, investors most often will move their money into bonds, which are considered safer investments in times of recession. So this will cause bond prices to rise and bond yields to fall. So during 2008, right, the recession, the yield on the 10-year US Treasury bond fell from about 4% in mid-2007 to below 2% by the end of 2008. Next, we have a currency devaluation. In some cases, a recession can cause a country's currency to lose value. This can happen if investors become concerned about the country's economic prospects and move their money elsewhere. So for example, during the Asian financial crisis in late 1990s, the Thai baht lost around 50% of its value against the US dollar, while the Indonesian rupiah lost about 80% of its value. Lastly, we have a decline in commodity prices. During a recession, demand for commodities such as oil, copper, and gold tends to fall, which causes prices to decline. So for example, during the same 2008 recession, the price of oil fell from a high of around $145 per barrel in July to a low of around $30 per barrel in December. So it's worth noting that not all recessions will have the same impact on the financial markets, and there can be significant variation in how the different sectors and asset classes perform during a recession. In other words, every recession is going to be slightly different, but most of these factors will tend to be in play, right? So it's always good to look at the overall big picture. So this is the most interesting part. Which is the best asset class to invest during a recession? During a recession, investors typically look for safe havens that can weather economic downturns. So for example, bonds like government bonds such as the US Treasuries are considered one of the safest investments during a recession. During the same Great Recession of 2008 to 2009, the US Treasury bond market gained 12.7% as investors flocked to safety. So another possible thing to look at is defensive stocks. So defensive stocks are companies that provide essential products and services such as utilities, healthcare, and consumer staples. So gold is another traditional safe haven investment that tends to perform well during times of economic uncertainty. During the 2008 recession, gold prices rose more than 25% as investors sought protection from the stock market's decline. Lastly, real estate can also be a good investment during a recession as interest rates tend to be very low and property prices may decline, providing opportunities for long-term investors. During the 2008 recession, housing prices fell sharply, but by 2012 they had rebounded and were rising again. It's important to note that no investment is entirely recession-proof and all come with some degree of risk. Investors should diversify their portfolios and consult with financial professionals to determine the best investment strategy for their individual needs and risk tolerance. In conclusion, understanding the causes, warning signs, and impact of a recession is critical for policymakers, investors, and the general public. It's important to keep a close eye on the early warning signs such as an inverted yield curve, high level of debts, or a slowdown in job growth. Moreover, investors should take a cautious approach to investing during a recession and seek safe havens such as bonds, defensive stocks, gold, or real estate. Now that I've covered all the strategies for a recession, what can you do to prepare for a potential recession? And also, how can you ensure that your investment portfolio is diversified and resilient to market downturns? Let me know in the comments below. And if you have enjoyed this video, do remember to like and subscribe and hit the bell notification icon to receive the latest updates. That's it for this video, and I'll see you in the next one.